It just became a lot faster and a lot easier to tap into your equity. So I'm talking about a very quick, easy HELOC loan. So let's go into what a HELOC is. Let's go into how to qualify for it and what it's used for. So a HELOC or a HELoan is a second mortgage. So you own a house, especially if you purchased it during COVID, you got that 2 to 3% interest rates and your values really shot up there. So you have a lot of equity in the house. Now, people really use HELOCs for multiple different ways. So I always keep a home equity line of credit, which is what it stands for. I always keep it open, about $100,000 at all times on my property. I've not used it once, but it's there if I need it. For me, what I would probably use it for, and what my husband and I are actually talking about using for, is it's like 9% interest. It's not much if I use it, but if I want to do renovations on my house, instead of taking any of my money out of other investments, I'm just going to do the HELOC, pay the 9%, and have a plan of attack for actually paying it off very quickly. So that's one way to use a home equity line of credit, is to actually do renovations on the house. Another way, some of my favorite ways that people use it for, is they want to buy another home. They're living in a home, they want to rent this house out, and they're going to purchase another one. So they're pulling out their equity for a down payment on the next house, whereas this house they're going to be renting out. So now they're increasing their long-term wealth because they have two homes that are going up in value. Another way I absolutely love, where you're making your money work for you, is when people take a HELOC, they pull the equity out to add on an ADU, an accessory dwelling unit. You can add on an ADU, you could take your garage, a 20 by 20 garage, which is your typical 2-car garage. You can add a 1-bedroom, 1-bath, about a 400 or so square foot little studio. And in Riverside, that rents out between $1,600 to $1,800 a month. Or you can go in the backyard and you can build a ground up ADU, where that's, maybe 750 square feet, 2-bedroom, 3-bath, somewhere right around there, where it's going to rent out for $2,200 to $2,400. So that's taking equity from your house and turning it into cash flow. So those are a couple of ways. But one of the bigger ways that I'm seeing right now is credit card debt is an all-time high. And I don't know if you do have a balance on your credit card, and I don't know if you've looked at it recently, but the interest rates on those are 27 to 30%. So you can actually take a home equity line of credit, pay off, consolidate all that debt to that interest rate there. Those interest rates are between 8 to 11%, depending on how you qualify. And now you're not paying that exorbitant interest rate anymore, and you have a fixed payment that you're paying to. Now, how do they qualify? What are their terms? So when I say a fixed interest rate, you can actually choose to be, if it's adjustable, it could be an adjustable HELOC, or you can have a fixed HELOC. You can choose, hey, I want a 5-year term. I'm going to pull out $100,000, but I'm going to make sure I have it all paid off in 5 years. So I want a fixed 5-year term. So you could do that. So you could do fixed 5, 10, 15, 20, or 30 years, which is super awesome. You could choose if you want it to be an adjustable rate or a fixed rate. Now here's some caveats. You do need to leave a little bit of equity in there. For the better rates out there, don't get me wrong, you could go where you only leave about 5% equity and you have higher rates. But for the better rates, you really want 15% equity left in the property, meaning your first loan is eating so much equity, and then your second loan is going to eat a little bit more of that equity. So about 15% equity left in. You need to have a 640 FICO. There's really no home equity lines of credit you can tap into without that 640. The second mortgage is a little bit more of a risk to the bank, so they want to make sure your credit is really solid. Some of the banks require an appraisal to be done. Some of them don't. They'll just go behind the computer and they'll do like a desk appraisal. So there's really lenient, sometimes there's a lot of things that we need, like income, bank statements, tax returns, and then some HELOCs, you can do it with really not much documentation at all. We just really need to see the equity. So no matter how you use it, whether it's paying off credit debt, whether it's buying another house, whether it's doing renovations to your house, whether it's putting an ADU on it, you could use it for travel, you could use it for medical bills. It is endless. But what I love about HELOCs is when you pay it off, if you need to, you can trot back out again. So you get like a checkbook. With mine, I have 10 checks that I could use against my HELOC. You could do HELOCs as small as $25,000 loan amount, just in case, like an emergency reserve, just in case you need it, all the way up to $400,000. So it's one of those things, whether you use your home equity line of credit or not, It's really nice, and it gives me peace of mind to be able to say, I have $100,000 open to me just in case something comes up. In the event that I need to use it, I can write this check and have money instantly. Definitely call me for more information. I have blogs about it. I have fact pages about it. And if you're interested, the application is super quick and easy. It's about a 5-minute application. You see rates instantly from there. We made it fast. We made it easy. It's just getting better and better and better because there's so much need for it out there.